This is an internal control success story from EY's client named Smith Corporation. Smith Corporation had a portfolio of available-for-sale securities. Available-for-sale securities are recorded at cost and then adjusted to fair market value in subsequent periods. Over time, the market value of Smith Corporation's available-for-sale securities increased. Because Smith Corporation didn't end up selling the securities by the end of the year, they had an unrealized holding gain. The unrealized holding gain was recorded in other comprehensive income net of tax on the financial statement books. However, because the gain was an unrealized gain and no cash was received, it wasn't recorded for tax purposes. This resulted in a deferred tax liability because the book income was higher than their taxable income. The deferred tax liability is classified as a current liability on the balance sheet. Smith Corporation had an automatic computer program that determined the deferred tax liability by multiplying the unrealized gain by the historical tax rate of 35%. No human judgment was involved. This is normally fine because tax rates don't change often. However, on December 22, 2017, President Trump passed the Tax Cuts and Jobs Act. This decreased the tiered tax rates to a flat corporate tax rate of 21%. Not to get political, but for the sake of this example, President Trump and his new tax law represent an internal controls threat because there is the risk that the financial statements won't be adjusted for the new tax rate. In actuality, Smith Corporation did not have any preventative controls to catch the recording error. Therefore, the first draft of the financial statements was printed and distributed to the office using the old 35% rate. However, management had a detective review in place where they would review areas of their financial statements that had high dollar balances and complicated adjustments. They selected a few high-value investments to test, and then discovered that the unrealized gain was calculated using the wrong tax rate. They then checked all of the investments and determined that they all needed to be corrected. When they recalculated the unrealized gain with the new 21% tax rate, they found that there was a $6 million difference affecting their other comprehensive income. Due to the tax rate change, the unrealized holding gain was recorded at a higher value. This was a detective control that Smith Corporation had in place because management was able to catch. This falls under the monitoring section of the Coso cube. Monitoring is defined as policies and procedures that help ensure that the risk responses, as well as other entity directives, are carried out. Monitoring can be done in two ways, through ongoing activities or separate evaluation. In this instance, the monitoring was a separate evaluation because the issuing of financial statements happens infrequently and tax rate changes are. Management was able to give feedback to the staff accountants and successfully correct the error. The revised financial statements were then printed and redistributed. This was all done before the auditors had to intervene. If Smith Corporation wanted to be more proactive, they could have put in a preventative control where the corporate tax rate has to manually be entered each year. Staff accountants would be required to check the IRS website and see if there have been any changes to the tax law. They would then have to enter the current tax rate into the accounting software and will receive an error if they attempt to bypass this step. Here are some pros and cons. This preventive control can be classified as a control activity on the Coso cube. A control activity is defined as policies and procedures that help ensure that the risk response. In the end, Smith Corporation's detective control was adequate enough to make their internal controls a success.